In our previous show, Tina Barrett from Nebraska Farm Business joined us to look at how narrowing margins in the grain market could affect producers. This week, Tina is with us again to look at tax preparations and new health care laws. The group of producers Tina works with saw a drop in net farm income for 2012, falling 8% from the record high levels in 2011.
Normally what we did, our history is we'd see a good year and a bad year, and we'd even out the tax liability right in between those, and we'd have inventories going up and inventories going down. Well, for the last 5 years, we've saw nothing but rapidly increasing inventories and tax deferral. And so we've got one bad year following 5 of the best years we've ever had. And so I think for a lot of producers out there, we can't change a whole lot on the tax situation as far as where we're planning to be, because we've got a lot of deferred tax liability to eat up.
Which means what? What would you recommend there?
Well, I think it's going to be really important for everybody to sit down and maybe look at their individual situation with their accountant, and maybe not just do what they've always done for tax planning and get to the exact same spot. They need to look at maybe changing their strategy, using up some of that inventories, getting some of that converted into cash before the end of the year. It's a tough thing to do because nobody wants to pay more taxes, but we got to think about what's best for the business as a whole and long term, and that might mean raising that tax liability up just a little bit.
Everything that went into effect at the beginning of the year when we did our 3-part series
Right.
trying to diagnose what was going on here, has everything kind of evened out now? Do you have a handle on everything? Do producers have a handle on it?
I think we've got, for the first time, we're looking at tax rates that we know what they're going to be. Whether we like them or not, we know what they are, and that's at least something we can plan around. And that's a much better position than where we were a year ago. We've got estate tax nice and settled out, indexing for inflation. That's dealable. We can do some good estate planning with that. The only thing that's still up in the air is what they're going to do with depreciation. They didn't make that a permanent extension. They just extended the enhanced depreciation through 2013. So as we start 2014, we're still looking, just like we were a year ago, at no bonus depreciation and something around 30 or 40,000 of Section 179. Which, when we're comparing that to $500,000 of Section 179, it feels like we've got nothing.
As you start to look at the new health care law that's going to kick in, there's 2 differences here. The individual mandate would go in 2014, January 1,
Right.
but the business mandate would go in January 1, 2015. Is that accurate?
It is. And I think for most farms that we're talking about, we're looking at the individual mandate because the business's mandate is with those with 50 or more employees, and we don't see a whole lot of farms with that kind of hired help.
What would they need to do to get ready for this?
I think, if you've got health insurance, you're good to go. If you're not having health insurance, it's something that you've got to get in place because they're going to hit you with a tax on your tax return for every month that you don't have health insurance for 2014. And it's, of course, a complicated formula. It's not something simple. But so it's just a matter of getting health insurance on board. And I believe the exchanges are supposed to be open by October 1st so that you can buy off of those if you don't want to go to a private health insurance company like we've done in the past.
Right. Now, the differences on how you earn your income will be taxed at a different rate as well?
That's right. So part of this health care bill was an additional Medicare tax. So on earned income, they're charging an extra 0.9% on any income over $250,000, and any unearned income, it's 3.8%. And really, what they're doing, we've paid a 2.9% Medicare tax, all along. So they're just taking both of them up to a 3.8%, and you're going to start paying Medicare tax on unearned income, and that's rental income, interest, dividends, those kinds of things. Earned income would be wages, farm income, and that kind of stuff. Depending on what your business structure is, if you're structured as an S corp, you could potentially avoid some of that on both, and that's be one of the few places where it wouldn't touch either one. So
when would you like to see all this done by? Have the farmers kind of have this in the ground by?
Oh, I think tax planning is an ever-changing thing from now until the end of the year. But I think it's time to start looking at what you want to do so that as you go through harvest, whether you want to sell off the truck, whether you want to pay for those inputs as the dealers start coming around, that you know what you want to do, at least in a broad sense, before you get busy. And then it's time to fine-tune right through the end of the year.